Hello. So, welcome to this class where we are going to learn about put option. But before we go and learn put option, I want to tell you two things. One, I would like to give you one formula through which you can remember always when to apply call and when to apply put. Okay? As a person who consider himself as an investor or even as a trader, let's say, or a speculator or someone who is trying to manage the risk. Yes. So this is first thing which I'll tell you. And the second thing, uh, generally, these concepts get introduced in future adoption class in the very beginning itself. But then I purposefully skipped it from last class because I just wanted to show you the calculation and make this call and put option interesting for you. Okay. So in the money and out of the money, just a brief discussion on that because when you will move to option trading strategies, that time you will have to remember these two things really well. I mean, option trading strategies will be not for the investors. So person who is attending my course with the vision of becoming a great investor and don't want to explore the opportunities in trading can skip modules from here onwards. I have been telling this from very long. Here onwards means this last one, which is risk management module. Great. So these two concepts will be introduced, and in the same fashion, we will learn about the put option the way we have learned about call option. We'll open the option chain and we will try to do some calculation. But then I am going to make this class a little lengthier than call option because most of the concept of option, which probably I wanted to teach you, from my own experience, I should have covered when we started the call option, but then I wanted to make it brief so that it becomes interesting for you and you just go and do the calculation and explore more option chains on different underlying instruments. So let me do a recap here and consider this that the crux of the options will be given into this class. You know? Okay. So you remember about call option. So what did you do in the call option? You saw that there is something called a strike price. So if you have one instrument, let's say there was Reliance, then in front of Reliance, you would have seen there are many options, not one option, right? So similarly, you will have many options beside that underlying on the right hand side on the option chain, if you remember that visuals, right? So option chain, you have already seen, you have done the calculation of the call options. We will do the calculation of the put option. You have also learned about future in past in the initial classes, but then I want to do a recap here. Okay. So futures were nothing but a kind of contract between two parties where you must have to oblige the contract. Oblige the contract means if you have done the contract, you have to live up to the rules and the terms which is given there in the contract. So if you have written in the contract that you will sell something, you must have to sell. If you have written something in the contract which says that you have to buy something on certain date at certain price, you have to buy that, right? So two, three concept which you learned was strike price in the options. Then lot size is something which you understood and you must be remembering now. So lot size is nothing but every contract will have an underlying, and when you are going to create that contract to make it a future or option, you have to make sure that the number of units has to be defined. Then you have learned about the expiry date, which I told you that the monthly options expiry date will be last of every month. Then option is also a contract, but as the name suggests here, options is such contract. If you are a buyer, you will have a choice. You will have option to oblige it or not to oblige it. And there you learned about call option. And call option gave you a right to buy or not to buy the underlying contract. This is what I explained you in the earlier class, in the previous class. But in this class, if I have to just tell you the definition of put option and want to do you the exercise, put option will give you a right to sell certain instrument or not sell certain instrument at the date of expiry on that strike price. Okay, so one give you option to buy or not to buy, another give you an option to sell or not to sell. This might be sounding little uncomfortable for people who are new to options, who are learning options for the very first time, who are new to the market. So I got two words for you. I'm sure in my own classes you would have heard about these two words called gear, greed, and fear. Sorry, I mixed up these two words and I said gear. Greed plus fear is gear. Great. So remember gear word now, probably, which defines overall options. Greed and fear are two keywords I have been telling you from very long time. So if you are feeling greedy, okay, what I'm saying, if you are feeling greedy, do we ever feel greedy? I feel greedy. You feel greedy. The whole world is greedy for something. Some people are greedy for knowledge. Some people are greedy for money. Some people are greedy for fame. And these are our emotions. And we humans are made of these emotions, right? So greed is one emotion. Fear is another emotion. When you hear about the stock and market, these both emotions work on probably, in the best of its format. Either you are very afraid or you really feel greedy to make tons of money. And that's why I keep telling in all my classes that one thing which you have to practice is probably how to control your greed and fear. But then, when I have to explain call option and put option, I would like to use these two words so that you always remember about call option and put option. So, here is my definition for call option. Every time you feel greedy, and you really want to satisfy your urge of greed, use call option. And every time you are afraid, you have to use put option. Great. What does it mean? It means very simple thing. You are thinking that Reliance is trading at 1500 rupees. It will go to 2000 rupees after the quarterly result. Now, you don't have that much of money to invest into Reliance and take the benefit out of it. Let's say you just have 10,000 rupees with you. Okay. How much money you will make? You are very confident of your analysis. And you think that Reliance will go to 2000 rupees, means it is going to give around 33% return just in 2 days. How many days? Just 2 days. After 2 days, there is a result expected out of one share called Reliance. So if you invest, let's say that 10,000 rupees, how much profit you will make? Something around 3,300 rupees. But that don't satisfy your greed. Your greed is that this 10,000 rupees become 1 lakh rupee. Okay. How will you satisfy your greed? I know I'm not teaching you anything wrong here. I'm 100% sure here. Okay. So don't go at this language that when you are feeling greed, it actually is greed. When you buy a call option with certain assumption in your head that this instrument will actually fly means going to give you a humongous return. A good return or a good appreciation is about to come into that stock or is about to come into the index, and you want to grab that as an opportunity, you can use call option. How? Again, 1500 rupees you are having the Reliance stock price. Okay. Now, if you want to really make a benefit of your own analysis where you think it is going to go 2000 rupees, what you can do? You can buy 1600 rupees INR strike price call option, isn't it? This is what I shown you in the option chain, that you can buy a call option worth 1600 rupees, and let's say the lot size is 500. Let me Lot size is 500 and option price is how much? 20 rupees. It will be more or less like this. Then all you have to give is 20 into 500, it becomes 10,000 rupees. And now, if actually your information becomes correct and Reliance rally to 2,000 rupees, what will happen? This call option gave you a right to buy or not to buy at the date of expiry. So you have the underlying of 1600 rupees. Sorry, the strike price is 1600 rupees. Underlying instrument price is 1500 rupees. 20 rupees premium you have given in the call option and you bought at 10,000 rupees. Now, what will happen that you will exercise this right because in market you are going to get Reliance in 2000 rupees. But as per your contract, where you have done a contract of buying Reliance shares at 1600 rupees, 500 quantity, this is what call option tell you. You go and buy at 1600 rupees, and what is the immediate benefit you get out of it? You bought something at 1600 rupees, which price is actually 2000 rupees. So you make an immediate profit of, now the lot size was 500. On one share, you make 400 rupees. On 500 share, you make how much? You make 2 lakh rupees, right? Your greed got satisfied. This is what is call option. It gives you a right to buy or not to buy, and only when the prices will fly, you will buy. And only when the prices will not fly, you will not buy. You will leave the call as it is. You will make a loss of 10,000 rupees, which is the premium. Now, you may not always want to be a buyer of call option. You may want to be a seller of the option, but selling part I'm not going to teach here in this module, but the selling of option and how it works will be covered only in the option trading strategies, and there is a reason behind that. And reason is again very simple. Selling of option is more like a trading activity and not an investing activity. And I want to restrict this risk management module only up to a risk management module for all of you, all you investors. So, can you see that your greed got satisfied in the call option? Yes, you have seen that. You have to take more examples. Call option already I have covered. I have covered through showing you the option chain, right? I just repeated it. Now, I want to learn put option and we will open the option chain. But before that, let's cover the fear part. So what is fear? Now your fear is that you have 500 Reliance at 1500 rupees only, which is, but let's say you bought at 1500 rupees only today, and tomorrow you have one result expected of Reliance where you are really afraid of it. What if the bad result comes? What if from 1500 rupees it goes to 1000 rupees? Are we afraid by nature? Yes, we all are. You, me, everyone. The way we have greed, in the similar fashion, we have fear as well. Okay, now how to overcome this fear? There is no way to overcome the fear. We have seen on multiple occasions, all companies after quarter results, one or the other quarter, they show bad results. It's business. I have been telling you that the stock market is nothing but business. Businesses may perform well, businesses may not perform well. A good quarterly result may come, a good quarterly result may not come. And you will have a fear to lose your hard-earned money. Okay, and how will you lose? You will lose because you have bought at 1500 rupees. You have a fear that it will go to 1000 rupees, and you are really afraid of it. You could short a future, Reliance future. When you short Reliance future, what will happen that you will make money in future. If you remember the future, which I explained you in the early classes, future is a contract which you can buy, which you can sell as well, and you have to oblige at the expiry date. So if you sell a future, you have Reliance shares 500, and let's say the lot size is also 500, then you can sell future, and if a stock prices fall, you will make money in future, but overall value of your portfolio will come down. So you may make a profit of 1 lakh rupees in future, and the value of the portfolio will also come down by 1 lakh rupees. So you will be in no profit, no loss game if you try to hedge this event which is there tomorrow. You should have enough number of Reliance shares. Enough number means number equal to the lot size of Reliance future. Yes, this is how you can control your fear. But then you are not in Reliance because you want to be in such a situation when if Reliance give good result and going to give a positive return on it, you should not lose that opportunity. So it's not only greed and fear, it's also about the opportunity of the money. You are invested into the stock market because you want to create opportunity and make better return for you because of your investment skills. So hedging through future will obviously control your fear, and give you a little bit premium, very little premium if you are lucky. Okay. But then what if Reliance goes up? So you were afraid of, you still bought Reliance because it will go up in the long term, you know, but then you had fear. So you shorted the future, hedged your Reliance portfolio, or any portfolio which you have, you found one instrument in derivative market which is highly correlated with the pricing of your existing portfolio. And then what you can do is you can basically hedge, do the risk management by also shorting the future. But then it will not give you the benefit if your own fear worked against you. How can it work against you? Because you have bought Reliance with an anticipation it will go up, and it actually after the result went up, and it went up by 5%. Now what will happen? Your actual portfolio will make some money for sure. No doubt there. You if you have bought 10 lakh rupees worth of Reliance, 5% appreciation means now your portfolio value is 10 lakh 50,000 rupees. Done. No worries. But then the future which you have shorted, and let's say that total future value is again 10 lakh rupees, then in derivative trade, you will make a loss of 50,000 rupees, and again it get adjusted. So why you are in market? You are not in the market just to see these events. You are in the market to make money. Okay. And let's say you are in a situation where you are thinking that whatever may happen tomorrow after the result, it will go on the extreme side. Because most of the time, after the quarterly results or after any related event, most of these stocks show significant gain or loss. So there comes the concept of put option. Put option gives you a right to sell or not sell the underlying instrument at the strike price at which you have taken the put option. Unless and until we take an example, it will be really difficult to just visualize. And as I told you that this is going to be a put option class, in true sense, from here, we will start the class of option, put option. But always remember, when you are feeling greedy, you will buy call option. When you are feeling afraid, when you have fear, you can basically keep this fear away by buying put option. How is something we will see on the screen. For that, we need to open our favorite NSE website. So here we have NSE. Okay. Now let's say since we have been taking I have no biasness against Reliance. I'm not telling you people to buy Reliance or something. It's just that one of the security I had to take, and I have taken the company which is having the highest market capitalization in India at this point of time. So here you have uh, Reliance, you have derivative, and then what we need to open? Option chain. So we have opened the option chain. Left hand side, call option, you remember that. Right hand side, put option. Underlying price, 1763. So tomorrow, there is a result expected of Reliance, let's say, when I'm recording this class. And you are afraid of what? Reliance going to 1500 rupees from 1763, and it will really create a mess for you. You will lose some money, and you want to create, protect your Reliance portfolio. So 1763 is something which we will remember for once. And with my own experience, what I will be doing is what I'll show you. So 1763 is there, and I think 1763.20 is one instrument which is already there, 1763. So this is the strike price which is there. And in this case, if I really don't want to make any huge loss tomorrow, because tomorrow is expected result of Reliance for assumption, then what I'll do, is I will buy a put option of a strike price 1763. Okay, so definition I told you, but definition don't help. The real example help, and we have taken the real example. The last traded price is something which we will pick up from here itself, which is 1763 is 36 rupees. And lot size we know is 505. So we have a situation where the underlying price is 1763. I'm not taking after the decimal. Then I'm buying a put option, strike price 1763 only. We are lucky that we got the same option. Okay. How much was the price? Price we got is 36 rupees. 36 rupees. I will not write rupee. We can write rupee here. Now, there was something called lot size, which is 505. So how much will be my investment? I can call it investment. Well, why to call a wrong term? It is called premium. Okay. So let's say you are making an investment by giving a premium investment towards overcoming your fear, where you don't want to take hit if stock prices fall drastically tomorrow. Okay. So the premium which you will be getting, since you are buying an option, and as I told you, when you have to overcome your fear, you will buy a put option. When you are feeling greedy and want to take a benefit, you will go and buy call option. So 505 into 36. Now 18,118 rupees is something which you can give to the market or this option seller. And what did you get? Every time you take a contract, the first thing which you get is a right to buy or not to buy in call option, right to sell or not to sell in put option. So you got this put option at 18,180 rupees, and this put option gave you a right to sell Reliance share at 1763, right? So here what you have is two situations which may happen tomorrow. Reliance may go to 1000 rupees or Reliance may go to 2000 rupees. You got a right to sell 505 shares of Reliance Industries at 1763 to the seller of the call option, seller of the put option. Now you tell me one thing, try to visualize here, take a deep breath, just think about it. I'll also go slow here. I'm recording it also for the people who may be understanding it for the very first time, and I have seen that people find it difficult sometimes call option and put option to comprehend and to remember. And that's why I'm repeating it again and again. I'm sorry for being theoretical here. Okay. So here you got a right to sell or not to sell. So if at 1763, remember, okay, so if Reliance goes to 1000 rupees, means the market price tomorrow of Reliance will be 1000 rupees, then will you go and sell this guy at 1763 or not? I'll take a pause here and you think about the answer. Repeating the question. If Reliance goes to 1000 rupees tomorrow, and you have one paper where it is written that doesn't matter what the price goes, you will exercise the right to sell this guy at 1763 if it is favorable to you, if you have that option to sell or not to sell. So if it is going to 1000 rupees in the market, you will have two choice. One, sell to this guy at 1763 or sell it in the market at 1000 rupees. Where will you sell? Obviously you will sell. You will exercise this right. So when market is falling, you will exercise the right which has been given to you by buying the put option. But let's say it goes 2000 rupees, means you were afraid that it will go down, but it didn't go down. It went up. Now you got two choice here. Sell to the seller of the put option at 1763 or sell anyone in the market at 2000 rupees. What will you do now? Obviously, you will not sell it to him. You said, okay, I have an option, put option, which gave me an option to sell you or not to sell you. So I will choose for the other option where I will not sell it to you and I'll sell it in the market. Be happy with the premium which I have given to you. This is what you will tell to the option seller. Okay. You will never get to meet your option seller. What I'm trying to give you is basically a scenario where if physically two people would be meeting, this is what the put buyer would be telling to put seller, that I don't want to exercise the option with you where I have to sell you at 1763, which is like the strike price of this instrument. You got it right. So in both of the case, you can see what will happen. In the case of 1000 rupees, you will go and exercise the right. And your right is you can sell at 1763. However, the market price is 1000 only and the lot size is 505. So only this put option, let's say, and tomorrow is only the expiry also. I have not yet gone into the option pricing, remember. Okay. So the calculation which I am telling you right now is something where tomorrow is also the expiry price, and tomorrow itself this whole series will expire. Means this option is going to expire and you have this contract. So your option will become or have a price of 3,85,000 or 315 rupees. Or let's say you waited for the option expiry till last Thursday, and by that time it goes to 1,000 rupees. It may fall 10% tomorrow and keep on falling till the time of expiry. And at the day of expiry, it closes at 1,000 rupees. Then you know what will happen? You got the right to sell him at 1763. You will sell him at 1763. You may sell it to him at 70, not you may, you will certainly sell it to him at 1763 when the market price is 1000 rupees. And because of this put option which was there into your account, you make an benefit of 3,85,315 rupees. Obviously you are still holding Reliance share, isn't it? So this is what you get. But then, is it the real profit which you get out of exercising the put option? No. What is the real benefit you get? The real benefit which you get is basically the you have to subtract the premium. So this is the profit, or you can say the benefit you get when you buy this put option in this example. Now you may say that yes, I made this benefit, I made this profit, and that hedged a good component or a good that hedged my overall Reliance portfolio up to a great extent or a good extent. You know, so your overall Reliance, now you are having Reliance. How many? 505. And it has come down to 1000 rupees, So what you can see here is out of 1716.3 minus, it has come down to 1000 rupees. Your overall Reliance portfolio will stay at 3,85,315 rupees, which were originally there for 8,90,315 rupees. So, you know, So if you can see, you your overall portfolio, if you see here, that let me do this recalculation. So your original portfolio is of Reliance is 8,90,000 rupees. Your expiry value is how much? 1,000 is the current price into 505. So your current expiry value of your portfolio is this much. So how much money you lost? So basically in your overall portfolio, the money which you lost is 3,85,315 rupees is your portfolio down by. But you made a benefit of 3,16,7,135 rupees because of exercising the put option, because you were having put option. Now, what will be your overall since you are down by this much and you made a profit of 368 rupees, what you will see that the money which basically whatever is the premium is something which you are going to lose whether you buy option or put option. So even when you bought option, you were not able to safeguard all the loss which has happened because of stock price coming down from 1763 to 1000 rupees, right? Because one premium you have to give, right? And this is the beauty of the put option, right? Here, if Reliance would have gone to 2000 rupees, you would have made a profit of 1,19,685 rupees. What I'm trying to tell you that you buy put option because you are afraid that market will crash or the instrument will crash. And there might be a chance that it may go up also. So in option, you are taking this benefit. The benefit where if market goes in your favor, profit is yours. But if market goes down, deep down, then loss will be borne by someone else. Who have collected this premium from you. So as a option buyer, your loss is maximum up to the premium you have paid. If you would have bought this option and market would have gone up, you would not exercise the right, your option premium is gone. If market has crashed and you gotten a chance to exercise this option right, you safeguard your portfolio, but still the money which you have given in the form of option is gone. We took a very simple example here. The example was where the strike price was nothing but the same price at which the underlying was trading. In your own exercise, what you can do that you can keep calculating the profits and the loss based on different strike price. For that, let's say, go to the option chain only. Now you see 1763.36 rupees. If you want to go and buy 1700 rupees option, you will buy it only on 13 rupees. Again, this will be covered in the option pricing that why it is 13 rupees and why it is 36 rupees. But what you see that the more you go far from your underlying price, the lesser price you have to give in the put option for the premium. And in call option, it goes just against it. In call option, let's say 1763 rupees will have also a call option. It is 37 rupees, and the far you go, the lesser premium you have to give. Why? Because the person who is selling you these options, call option or put option, he can say that the probability of market crossing 1763 will be very, very high tomorrow, or at least higher than 1780. This person, the person who have sold you the option, he will start making loss only when it start moving up. So it is always favorable for him if you buy the options which is far, far away from the underlying price in call. And in put, it is much better for him that you buying something which is far away again, but in the reverse order. So 1763 is the strike price, 1763 is the underlying price. Now, if market crash tomorrow, it may go to 1600, 1500, 1400, or 1300. But for an option seller, the far the strike price is, the more beneficial it will be for him, right? And there where I would like to quickly cover these two concepts called in the money and out of the money. And this again can be confusing terms. So you have to be careful here in understanding it. So 1763 is the strike price. I'll just enlarge it. Please look at it. Okay. So this is your, I'm sorry, 1763 is the strike price. Now for call, anything below 1763 will be called in the money call because it is going. So if you see 1760, 43, what you can see that the strike price is below the underlying price. Underlying price is 1763. This is what we have seen in the quote. Okay. So anything below 1763 will be called in the money for call option. But if you go for the put option, since a person who is buyer of the option, he would always want to sell higher. So anything where he want to sell higher will be called in the money for him. So if 1763 is the strike price and at the day of expiry he want to sell at 1780, he will buy 1780 put option and it will be called in the money put option for him. Okay. So as a buyer, you will always want to buy as low as possible. And then you choose for those options where you can buy at much cheaper price than what the underlying price is there. So for buyer, when you want to buy cheaper, it will be called in the money strike price. If you are a put option guy, you get a right to sell, you will want to sell higher and that will be called the in the money put option. This is how you have to remember. Okay, you do not have to confuse here between one thing, that in the money option or in the money call option and put option will always have lesser price than underlying as per the definition. No, it will just reverse. In the money for call guy will be below strike price, below underlying price. The strike price will be called in the money. So 1740 is called in the money call option. However, 1820 will be called in the money put option. Okay. And anything, anything when it goes far from you, you called out of the money, right? So if you buy 1800 rupees call option, you will be called you are buying out of the money call. Why out of the money? Out of the money because if you see, it has to go first from 1763 to 1800 rupees, which is out of the current money, and that's why the strike price is higher than the underlying. Okay. Here at 1763, what you can see is if you buy 1723 rupees put option, you know, first it has to travel from 1763 to 1723, and then only you will start taking benefit if market crashes from here. If you bought this put option and market crashed in your favor, I mean, you took a put because you were afraid that market will crash and it will come down below 1763, so it may come down to 1743 only. And still at this point of time, if market has gone to 1723, you will not exercise this right of selling this guy at 1743 rupees when you can sell it in the market at 1723 rupees. So the more you go deep inside, it will be called out of the put, out of the money put option. So these are all out of the money put option. These are all in the money put option. So you have to remember this, that when you are going out of your own range, you will call that out of the money option. In call, This is your out of the range input, this is out of the range. So remember it, it's just a definition. Even if you don't remember it, honestly speaking, it don't make much difference. If you are an investor, you will always define your own range of greed and fear both. Okay, so I may feel afraid that if it start going below 1740 rupees, I must protect my portfolio. And then there will be another person who will say, no, 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 it's okay. Let it come to 1700 rupees and I'm still okay because I have bought it at, let's say, 1600 rupees. So I'm anyway sitting on a profit position. It will not make much difference to me. And I'm okay till 1700 and I'm confident on Reliance Industries. Even if it goes down by 4 5% tomorrow, it will come up. I don't want to pay premium, which is a kind of insurance. As I said, some people may want to, not, I never said that, but I can also tell you that apart from remembering this greed and fear for call option and put option, something which you can also remember is term policy. Some people buy term policy of 2 crore, some people buy term policy of 50 lakh rupees. So this is more like if nothing happens to you, it goes to the insurance company, that premium which you have given him. But if something happens to you, God forbid, this money, 1 crore or 2 crore, whatever you have taken the premium for, will go to your family, right? So, put option is more like your car insurance, your car premium, your own term policy, and all those things. So, some people may take at the money option, some people may take out of the money put option because they are okay with this kind of range, you know. But since we are going to use this extensively in the money, out of the money, in option trading strategy, for traders, it will be advisable to remember these terms. Well, this was all put options. I would wait for your feedback, whether you got it right or had any confusion. You can always WhatsApp me. You have the WhatsApp number. Thank you. And in next class, what we will learn, we will, so similarly, I mean, slowly and slowly, I'm giving you the different concept of the options and futures. So in next class, we are going to learn about option pricing. Why this price is 33 or 36 only, and why this price is 1300 rupees. What are the factors which are determining these prices? And the journey of again options towards its expiry. This is what is going to covered in the next class. See you in the next class.